What we're seeing this week with strategy goes way beyond entertainment. This isn't your standard volatility. This isn't a routine pullback. This has been a full stress test across Bitcoin, strategies, common stock, and the new preferred markets, and we're only a couple of days into the week. Bitcoin broke below $90,000, strategies common stock took another hit, and Stretch, the product meant to be the stable anchor, dropped from $100 to $92 as sentiment across the whole ecosystem washed out. Since then, we've seen sharp bounces in both directions. But in a market this volatile, nothing feels settled. Bitcoin is hovering near $92,000, and strategy has bounced back above 200, but the underlying questions around the business model are still very much in focus. So let's break this down clearly: what's happening, why it's happening, and what actually matters from here. If you find this breakdown useful, make sure to like and subscribe, and as always, nothing here is financial advice. All right, let's get into it. Before we talk about strategy directly, we need to start with Bitcoin because it sets the tone for everything else. And the key point is this: we've just seen another 30% correction. It's the third one of the cycle, and historically that isn't unusual for Bitcoin at all. But this one feels different because the speed of it, the context around it, and the complete collapse in confidence have amplified the fear way beyond what a normal Bitcoin pullback would usually generate. With Bitcoin dropping below $90,000, a 30% fall in 6 weeks, the narratives that propped up bullish sentiment have all broken: the 4-year model, the halving relevance, the Dixie inverse correlation, the M2 correlation, and the gold correlation, all broken. You don't have to believe in these models to understand their impact. They were the psychological scaffolding holding confidence together. And when those pillars start cracking, people feel exposed, and they start re-evaluating assumptions they treated as guarantees. And what about strategy? Because while Bitcoin set the stage, the reaction inside the strategy ecosystem was a shockwave all of its own. The common stock broke below $200, down 60% from July, and most alarmingly, Stretch, the stable, preferred, dropped from its designed $100 level all the way into the low 90s. That wasn't supposed to happen. Across the community, FUD hit new highs, trust hit new lows, and big questions continued to get asked. How does this model hold up if the Bitcoin cycle really is breaking down? What are the reasons to hold the common stock, and how does Stretch get back to $100 and stay there? Because if yesterday revealed something important, it was if Bitcoin breaks sharply, strategy's entire ecosystem, and the preferreds in particular, can react far more violently than anyone expected. So this brings us to the part investors are struggling with most right now: the common stock. Let's start with the noise. The thud is loud, it's everywhere, and we've even looped back to Peter Schiff, calling the entire model a fraud and predicting bankruptcy. Let's be clear, strategy is not going bankrupt. This is just clickbait. But the pressure on the common stock is real, because structurally, the business has changed. The model is more complex. Every preferred adds obligations, every issuance adds fixed commitments, and without a premium, without cash flow, and with no intention to sell Bitcoin, investors are left asking two very simple questions. How are dividends funded with no premium? And is the common stock the short-term shock absorber while everything above it earns the yield? And right now, the market is trading it like the answer might be yes. Just look at the timeline. The common is down 60% since July, and that decline lines up almost perfectly with the launch of Stretch and the updated guidance around equity dilution. Both events changed how investors think about valuation. Both changed how they view the role of the common. And from that point on, the premium didn't collapse. It unwound, slowly and consistently. Not because the business failed, but because the structure shifted into one where premium expansion has less room to breathe. Shareholders aren't doubting the mission. They're questioning whether the risk-reward profile still makes sense for the common stockholder. Because the same questions keep coming back: how the company manages expanding liabilities, how preferred dividends stay secure in flat or down markets, how obligations are met with no operating cash flow and no premium, and how the system works long-term if Bitcoin is never sold. And here's the part investors don't always say out loud, but the price action is saying for them: if conditions tighten, the common looks like the tool that gets used. That's the perception. And we even heard a version of this directly from Saylor. In the Cardone interview, he made it clear that even if Bitcoin fell 90%, they still wouldn't liquidate their Bitcoin. Instead, the lever he pointed to was issuing more equity. His exact line was, "We're never going to liquidate. The equity would be the loser." He wasn't being negative. He was describing the hierarchy. Bitcoin is protected. The common stock is the buffer. Operationally, that's rational. It preserves the Bitcoin. It keeps the mission intact. And new investors may step in at a discount. But optically, it affects Bitcoin per share. And shareholders care deeply about that metric. This perspective is shared by others too. Dan Hillary pointed out today that Strategy has issued equity below book value before to accumulate more Bitcoin, and he said he'd personally buy MSTR below NAV because it gives long-term holders a chance to accumulate the treasury at a discount. And that's the other side of this. If Strategy ever does issue common below NAV, it may pressure optics short-term, but it could also attract a new class of buyers who want Bitcoin exposure cheaper than buying Bitcoin itself. Funds, allocators, long-duration investors, they watch for that. So in a world where Bitcoin chops sideways or breaks lower, we're going to see whether future obligations are met by new raises, additional preferreds, selective equity issuance, or some combination of all three. None of this challenges the long-term vision, but shareholders want clarity on who carries the weight when things get choppy. And until that's explained directly, the market won't wait for certainty. It reprices the common first and fastest. Because here's the core tension. Bitcoin is a long-duration asset. Perpetual preferreds are long-duration instruments. But the issues investors are reacting to are short-term mechanics, short-term uncertainty, and short-term clarity gaps. The long-term story hasn't changed. The short-term communication simply hasn't caught up. And this is where we need to add balance, because even with all the pressure, there is a clear reason why you would hold the common stock. If you believe in Bitcoin, if you believe the preferred model will keep expanding the company's Bitcoin stack, and if you believe Saylor can access the global capital markets he's positioning for, then the long-term rationale becomes straightforward. The preferred structure, if it works as intended, should result in more Bitcoin per share over time. That's the core incentive for owning the common. And yes, that metric is taking a lot of heat right now whilst the stock price falls. But structurally, if this metric trends upward over the long run, it raises the fundamental floor under the common stock alongside the Bitcoin price movements itself. Saylor is aiming for tens of trillions of dollars of capital. There is a growth story here, a very large one. But for the premium to return, the short-term clarity needs to match the long-term ambition. And this brings us to the preferreds, specifically Stretch, the product meant to be the calm, stable, money market-like anchor of the Strategy ecosystem. During the Bitcoin drawdown, Stretch fell to around $92. For something positioned as stripped of volatility, that move caught a lot of people off guard. A small fluctuation is understandable for a new instrument, but an 8% intraday break is far outside what many investors believed this product was designed to do. So the question is, what actually happened? Some argue it was simply unfortunate timing. Bitcoin dropped sharply, liquidity thinned out, and everything was already on edge. Others point to the explanation Dan Hillary gave. Normal fixed income mechanics, ex-dividend price resets, accrued interest adjustments, and that typical sawtooth pattern you see in bond-like instruments. And honestly, both can be true at the same time. Yes, there are mechanical reasons for price dips, but the optics were still rough. Stretch had been trading very cleanly the week before, even in a down market, giving the impression that the peg was firm. Then on Monday, the first real stress test hit, and the reaction was much larger than expected. It did reclaim about 2% the following day, climbing back towards $96, but that kind of swing is exactly what many Stretch buyers were trying to avoid in the first place. Naturally, people started asking questions. How is Stretch designed to defend its peg? What liquidity support exists? What mechanisms keep this near 100 in a stress event? Is this normal behavior, or a sign that the design is still evolving? These aren't hostile questions. They're the basics any investor would want to understand. Strategy has been upfront about experimenting and iterating quickly, and that's fine for high volatility products. But for something marketed as a stability anchor, investors want clarity, not surprises. And that's where the bigger picture comes in, because raising the yield over and over isn't the answer. The yield is already incredibly generous. Increasing it further doesn't fix the core structural questions people are asking. It just papers over them, temporarily. Stability won't come from juicing returns. It'll come from confidence in how the product actually works. Stretch isn't just another product inside the ecosystem. It's critical for Strategy. Right now, this is their main tool for raising growth capital, without issuing more common stock. For that system to work, Stretch needs to trade reliably at $100. That's the level required for Saylor to use the ATM on it. If the preferreds can demonstrate consistent stability, they become a powerful, recurring funding engine for the company. If they can't, that entire pathway becomes much harder to execute. That's why this moment matters, not as a failure, but as a reminder that the mechanics behind Stretch need to inspire confidence. Because if they do, this becomes genuine innovation. And if they don't, it risks feeling like a product still being figured out while people are already inside it. So, after another shakeout, we're not seeing stability yet. We're seeing volatility, sharp swings, fast reversals, and a market that still feels uncertain. Bitcoin is hovering around 92,000 today, the common has bounced off the lows, and Stretch is back near 97, which is encouraging. But none of that means things have settled, and that's the real point here. Right now, everything is in wait-and-see mode. The stress event raised real questions about structure, communication, and how these products behave under pressure. Nothing that can't be fixed, but nothing that can be ignored either. And look, there's no doubt strategy of run every model to stress test how the preferred should behave across all Bitcoin price scenarios. But the market wants to see that play out, along with more clinical buying and firmer behavior at key levels. At this stage, Bitcoin's next major move will dictate a lot. If it steadies or turns upward, pressure eases across the whole ecosystem. If it stays choppy or breaks lower, the spotlight on these issues only intensifies. Either way, it's on strategy now. How they respond, how they clarify, and how they reinforce confidence will shape what comes next. And I'll say this clearly, I have zero doubt the dividends get paid. They will not defer them. The entire preferred structure depends on that reliability. Without a premium, I think we will still see them use the common ATM, which will raise more questions around the Bitcoin per share. But let's not forget the preferreds front-load the Bitcoin on the balance sheet. So I don't think the real story going forward is whether the dividends get paid. It's how they refine the preferred design and, just as importantly, where the common shareholder sits in this journey during periods of distress. In euphoric markets, everything expands: issuance, liquidity, leverage, and opportunity. It's the stressed market moments that reveal how the hierarchy truly works. For now, we're in uncertainty, and the next meaningful move from Bitcoin is what determines the path forward. So that's where we are. It's been a volatile week already for Bitcoin, for strategy, and for the preferreds. But it's not over, and it's not fatal. These thoughts are all my own, as always, and I appreciate you watching. Like and subscribe on your way out. I'll see you in the next one.